Hi, Bill Lethman here from Lethman Financial. Welcome back to our free video series on annuities. In this video, you'll learn about the second basic type of annuity, the fixed annuity. Fixed annuities are generally pretty simple. Similar to a CD or a bond, you get a fixed rate of interest for a period of time. The kinds of rates that you can expect will usually be slightly higher than the rates that you would get on a CD for the same length of time. So typically, just like a CD, you're going to get a higher rate of interest the longer you go out. Here are just a couple things to keep in mind. First, just like all other annuities, these are primarily intended as retirement savings vehicles, so they grow tax deferred, which can be an advantage for a lot of people. However, you need to remember that because of this tax deferral, you generally can't touch the money until you're at least 59 and a half. If you do, it'll likely be subject to a 10% penalty on any of your gains or interest. Another thing to watch out for are teaser rates. You may find, for example, an insurance company that's offering to pay a rate of interest well above the going market rates. Let's say 5% for 1 year. This may seem like a very good option if interest rates on similar investments are all around 2% or so, but this 5% teaser rate might be on an annuity that has you locked in for 5 years. So after the first year, your interest rate would reset and be set to the current market rate, whatever that is. Most of these fixed annuities, however, have set a minimum level of interest it'll pay no matter what. A few years ago, it was very common to see this minimum interest rate set to around 3%. Today, most insurance companies have reduced this to around 1 to 1.5%. What's nice about it is this. Let's say that you bought a fixed annuity a few years ago and now it's coming due. The going rate might only be 1 or 2% if you were a brand new investor, but because you are already in the contract and are guaranteed that minimum level of interest, let's say 3%, you would get the 3%. Fixed annuities also are not FDIC insured, so it's very important to look at the creditworthiness of the underlying insurance company. Fixed annuities are, however, very heavily regulated. They're required to keep dollar for dollar of their deposits and reserves invested in a very high-quality bond portfolio. They're also required to have reinsurance on the portfolio as well. So, to wrap up, fixed annuities offer a fixed rate of interest for a specific period of time. They're intended for retirement, so they grow tax deferred. Your money may be locked up not only for the term of the annuity, but also until you turn 59 and a half. And finally, they're not FDIC insured. So that's it for fixed annuities. I'll see you in the next video.